Major profit crash, thousands of layoffs, sinking stock prices. The future doesn't look too good for the Japanese automaker, and it's running out of time considering that the year 2026 is bringing a massive $5.6 billion debt, which indicates that the ride is soon to get wild. Nissan really messed up this time and it shocked the car market, so much so that we're not sure if it could turn things around anymore. Let's take a closer look. The clock is ticking. With a huge drop in operational profit and massive layouts and plans, Nissan is having a rough time. Still, the biggest challenges are yet to come as a massive debt load is coming in 2026. The company has a year left to prepare for the massive storm. While they owe about $1.6 billion in 2025, which is actually less than 2023, that figure is about to skyrocket in 2026, all the way to $5.6 billion. The bonds are in yen, dollars, and euros, and with recent trends in declining sales and plunged profit, there are rising concerns over Nissan's ability to generate enough cash. After all, that's been reflected through significantly increased debt default insurance costs as well as higher yields on its bonds. The problem is that Nissan has already slashed profit forecasts for this year, and nothing suggests that things could change in the following years. Instead, the company is currently in the save what can be saved mode with drastic cost-cutting measures that include significant layoffs. On the other hand, shares are close to hitting the cliff with a near 30% drop since the start of this year, with speculation swirling around about a potential downgrade to junk status, which would push Nissan out of investment-grade bond indexes, making its debt less appealing to big investors. Nissan, on the other hand, insists that it's got the resources to handle its debts, highlighting 1.3 trillion yen or around $8.3 billion. According to the current exchange rates, in net cash for its auto division and access to over 1.9 trillion yen in credit from global banks, which would be around $12.3 billion. The company also counts on further cash flows from its auto business, profits from its sales, and potential new debt issuance to manage its repayments. At the moment, Nissan has a Baa3 rating from Moody's and BBB from Fitch Ratings, which are both the lowest investment grade. On the other hand, S&P rates at BB+, which is the highest junk score. Despite Nissan's assurance, challenges remain. The company's auto division boasts a cash flow of over 440 billion yen, which would be around $2.9 billion in the first half of its fiscal year due to weaker earnings and heavy investments. At the same time, the company is forced to pour money into the EV program, so the strain isn't easing anytime soon. Massive layoffs and plans. Nissan sales are down, with the first half of the fiscal year ending with around 1.5 million units sold compared to 1.7 million units in 2023. It's a 7.8% drop that might not seem so drastic, but with a rising cost of EV programs and other challenges in mind, the operating profit saw a massive 90% decline. In absolute numbers, that would be around $214 million, which is nowhere near the initial estimation. So the only way out of this situation is cost cutting, which usually leads to drastic measures. One of them is a cut in workforce, and Nissan decided to make a pretty radical move with a plan to lay off 9,000 workers and reduce production by 20%. Officials still haven't provided more details about which factories are going to be affected by job cuts, but it's estimated that this strategy would save about $2.6 billion. That's not all. The company also plans to sell 10% of its stake in Mitsubishi, which would reduce its ownership to 34%. But cost-saving plans cannot change the course, because Nissan's problem is much deeper. China and US are the key. The only way Nissan can overcome this crisis is to stop the ongoing decline in key markets. That would be China and North America. In China, Nissan has been having a strong foothold for decades. It's been one of the most successful Japanese automakers in the world's largest car market, but things started to change with the emergence of electric cars. Simply, Nissan cannot match Chinese EV brands supported by the Chinese government. These EVs are significantly cheaper and more advanced with superior range and performance. With that in mind, it's no surprise that Nissan sales went down almost 15% in the first half of this fiscal year. In America, the Ariya, Nissan's most prominent electric car, doesn't qualify for the $7,500 federal tax credit as it's exported from Japan. But the inability to offer its EV with a competitive sticker price is probably the last thing Nissan has in mind at the moment when it comes to performance on the US market, because Americans are not impressed with electric cars all that much. The market shows modest growth, and the focus is rather on hybrids along with gas-only models. Nissan's problem lies in the fact that it doesn't have a competitive lineup in the combustion and hybrid sectors. For years, Nissan has been putting most of its effort into their EV program. On the other hand, there wasn't much faith in transitional solutions like hybrids, which is turning out to be a big mistake considering that the sector grows faster than EVs and that rival companies like Toyota are currently winning big on this technology. Finally, the gas-only segment isn't particularly great either. Nissan hasn't done much in the past few years to refresh its offer, which made most of its lineup inferior compared to key rivals, which led to the massive stockpile of unsold cars. Dealers are struggling to move these cars off their lots, which only led to additional spending on advertising and incentives. Simply said, Nissan models are a tough sell in North America these days. Trump brings no relief. With Trump as the new president of the United States, things won't be easy for Nissan, and the reasons are numerous. We already talked about the Aria and the fact that it doesn't qualify for the federal tax credit. Well, that could be the only model to benefit from Trump's victory, considering that the new administration plans to cut these incentives. The Aria will become more competitive, but the rest of the lineup won't. First of all, Trump plans to end the EV push and let the market develop naturally, which isn't exactly in line with what Nissan was doing in the past few years, as one of the rare Japanese manufacturers to focus on electric cars. Second, and probably more important, is that the new administration's plan to prevent Chinese EV penetration from Mexico. Trump plans revisions of the United States-Mexico-Canada agreement in the way that a 200% tariff on cars produced in Mexico is coming. And if you wonder what this plan made to prevent Chinese EV makers from establishing production in Mexico and expand to the US market has to do with Nissan, well, a big portion of Nissan's production is in Mexico. The Japanese manufacturer may have over 10 plants on US soil, but there are also 5 major plants located in Mexico, where Nissan produces some of its most popular models on the US market, particularly the affordable ones such as the Versa, Sentra, and Kicks. These models are designed for cost-conscious buyers, so it's pretty clear that new tariffs would do big damage in terms of competitiveness. The future and uncertainties. Low profit outlook, slow sales, struggle in key markets. Nissan's future doesn't look particularly bright. The Japanese automaker claims that it has a plan to change the course and get the company back on track. As for the US market, its plan is to strengthen the offer, with the promise of launching 7 new hybrid and electric models by 2028. The same question remains: is this enough to remain competitive in today's rapidly changing market? An even bigger challenge is to convince loyal customers to wait for its lineup of hybrids and EVs rather than going for already available alternatives. Toyota, Honda, and Ford are leading the pack with innovative hybrid technologies, while the EV sector seems less and less likely to be conquered, considering that the planned moves of the new administration favor EV makers like Tesla or even Rivian. Nissan needs to play smart to catch up with rivals, because from the current perspective, it seems like it's losing on both fronts. The future is uncertain and Nissan is running out of options. But the company still has room for a couple of good tries to aggressively push hybrid models and streamline production capacity and efficiency. Attractive incentives will play a critical role in moving the current inventory, while consumers will have to be won back by offering new models that are not just competitive in terms of price, but in terms of style and performance as well. Nissan needs to be able to make quick and decisive moves because the market is changing faster than ever. A lot of things will be resolved in the next few years, and Nissan will have to play very carefully because everyone is watching, from investors to dealers and consumers. The future will tell if Nissan can turn things around or not, and that future is near. Thanks for watching and see you next time.